Welcome everyone, and in today's chapter we'll be discussing about bonds and their valuation. Now, if you recall, in the previous chapter we noted that companies raise capital in two main forms, debt and equity. So in this chapter we examine the characteristics of bonds and discuss the various factors that influence bond prices. So some of the key concepts that we'll be discussing today would be looking at the key features of bonds. We'll talk about bond valuation. We'll talk about measuring the yield, primarily what you often hear as YTM or yield to maturity. And we'll talk about assessing risks. So as we already know, a bond is a long-term debt instrument in which a borrower agrees to make payments of principal and interest on specific dates to the holders of the bond. So basically it's a loan and the bond serves as a contract between the issuer and the holder of the bond. The issuer is the party that's in need of the funds, and that's why they have issued bonds, and the holder of the bond are holding sort of an IOU which lists various contractual terms in terms of what is going to be the face value, that is what amount of money is going to be paid at maturity. Maturity is also listed, which is the term of the bond, that is for how many years or period of time the bond is going to be in existence. Then obviously there is going to be a key feature called the coupon payment or periodic payment to the holder of the bond, which is serving pretty much like an interest rate on that bond. So with that basic understanding, let's discuss some of the other aspects of bonds. So bonds are primarily traded in an over-the-counter market. Some of the bonds are actively traded on an exchange, but most of the bonds are traded on over-the-counter. Most bonds are owned by and traded among large financial institutions, as and when some of these bigger corporations such as Microsoft, Intel, Apple, or most auto manufacturers or large corporations, they are in need of funds, they would float these bonds in open market. But more than likely what they'll do is they'll go to financial institutions and they'll float the bond issue to these large financial institutions, because they do become a good source of fixed income. Small firms also float bonds in the market, but largely you'll find that because of liquidity, the government bonds or the treasury bonds are very desirable, and then most of the bonds issued by well-known firms are very desirable in open market. So the Wall Street Journal reports key development in treasury, corporate, and municipal markets, which is on a day-to-day basis news items pertaining to bonds and their trading. So like I mentioned, some of the key features of the bond, first of all, is the par value or the face value of the bond. That is what amount is going to be paid upon maturity back to the holder of the bond, because at maturity that bond is going to be returned back to the issuer, and the issuer in turn pays back the face value of the bond to the holder of the bond, sort of an IOU being cashed out. The coupon interest rate is a stated interest rate, generally fixed, paid by the issuer. So for example, if the face value of the bond is $1,000 and the bond is paying a coupon rate of 9%, so $90 is going to be the coupon payment. It's generally multiplied by the par value to get the dollar payment of the interest. And there's a very interesting story behind the coupon interest rate. Now we are so used to trading everything online or through computers, but bonds have been in existence for over 100 years, and in their initial phase of trading, you'd find that it would be a paper certificate, a paper IOU, sort of a representation of the bond, which would have a face value of sort of a big paper certificate stating various contractual obligations of the bond, and then attached to that were those stamps, like a tier of stamps like coupons, which the holder of the bond could tear off at the periodic agreed time during the length of the bond, so that they could take and present it at a financial institution or agreed upon bank or other financial institution or the office of the issuer, and they could cash out their obligated coupon payment. So that's why it came to be known as coupon payment, because these were literally coupons. Now, maturity date are years until the bond must be repaid. And something that we'll be discussing in detail is going to be the yield to maturity, which is the rate of return earned on a bond held until maturity. They're also called as the promised yield. So this is a concept simply stating that if you were to purchase a bond at a set present value, whatever value it's selling in the market, and you were to hold the bond until its maturity, and you were to receive all the contractual coupon payments, what is your rate of return? That is that concept, the YTM, and we'll do some examples around that. So there's something called as call provision. For example, if it's a 10-year bond, and if the issuer feels it's favorable not to continue until the entire 10 years, then an issuer can actually call back the bond early. And that's called a call provision. It could be stated in the contract of the bond itself that the issuer is permitted to call back a bond. Obviously, there may be some penalty for calling early, but it allows the issuer to refund the bond issue if rates decline. So, for example, if the bond coupon payment is, let's say, 9%, and the market interest rates drop down to 2 to 3%, and the bond issuer can refinance sort of that bond at a lower rate, maybe around 4 to 5%. So it is in favor of the issuer to call back the previous bond issue and issue another bond issue, at a much lower rate if it's a large size bond issue. So that is simply, in this case, refinancing. So the issues where there is a call provision, bond investors would require higher yields on callable bonds because they'd like to get some premium for this feature, because it may not be the best interest of the investor. It does seem to be in best interest of the issuer, but not in the best interest of the investor. So in many cases, the callable bonds include a deferred call provision. That is, there has to be a certain time limit before the bond can be called, and a declining call premium. That is, let's say, if this is a 10-year bond and it has got a call provision which can be enacted starting the second year of issue, and if it's called the second year, the bond issuer might have to pay $50 penalty. And then let's say it's in the third year, then it could be a declining call premium, then it could drop down to $40 and so forth. So basically that's a declining call premium. That is, as time passes, the issuer may call back the bond but at a declining call premium. Now again, all of this is stated in the contract. There is no sort of a bylaw for generally accepted principles for all bonds. Each bond is created unique or different. So basically, we do not have a standardized characteristics of the bond that applies to all bonds. It is an agreed upon contract between the issuer and the holder. So one company or one agency, usually the Treasury, they may have a similar sort of characteristics on the bonds that they issue, but each different company may have different characteristics, though the basic premise is the same across all bond issues. So what's a sinking fund? Sinking fund, you could think of it as an escrow, where you have provision to pay off a loan over its life rather than at maturity. So it could operate in different ways. It's similar to amortization on a term loan. You could have a company calling back bonds at staggered time frame. So for example, if it's a $2 billion bond issue, it may be quite taxing on the company to pay a $2 billion worth of face value in one go. So they may just break it up. They may say, okay, we're going to call back 25% of the bond in the 7th year, 25 in the 8th year, 25 in the 9th year, and the rest in the 10th year, if it's a 10-year bond, just to make it easier for the firm to honor all the bonds that they've issued. Or they could be putting money aside in an escrow sort of an account, which they know they'll have to pay to call back the bond or to repay once the bond matures. So this is money being set aside to be paid back. So this does two things. One, it assures the investor that yes, the company is serious about paying back the money and their funds are secure. It does reduces risk to the investor and shortens the average maturity. But it may not be good for investors if rates decline after the issuance. Because if, let's say, investors are with a view that they're investing in a bond that's with the maturity of 10 years and the company places a particular callback or payoff earlier than that, and unfortunately that's a time where the market interest rates are low, more than likely the chances are the investor would find it hard to reinvest their funds in another bond or another investment which pays almost a similar coupon payment. So how are the sinking funds executed? You could have an X percentage of the issue at par for sinking fund purposes, could be called. Now, likely to be used if the required rate from market point of view on bond is below the coupon rate and the bond sells at a premium. So what's the required rate? Required rate is the denominator by which we calculate the present value for the future cash flows, the discount rate, or the rates at which the market feels there's a risk on a particular security. So in which instances you'd find buy bonds in open market, this is likely to be used if the required rate is above the coupon rate and the bond sells at a discount. So these are the two suggested scenarios. This is what the companies are likely to do. So what is the value of financial assets? Remember, we discussed about the value, which is the present value, and this is equal to the cash flows, the periodic cash flows divided by 1 plus r raised to the power t. The risk to these future cash flows, required rate, as we just discussed, in whatever way you want to put it. This is just to give you some basis to assess or value the present value of any asset, or it could be bond as well. So what are some other features of the bond? Now you have convertible bonds. which may be exchanged for common stock of the firm at holder's option. You have warrant, which is a long-term option to buy a stated number of shares of common stock at a specified time. You could have putable bonds, which allow holders to sell bonds back to the company prior to its maturity. You have income bonds that pay interest only when interest is earned by the firm. And you may have index bond, which is indexed to some aspect, primarily inflation. So interest rate is paid based upon the rate of inflation. Now, if it's a 10 to 20-year maturity bond, that's quite a long maturity. So it's very hard to assess what the inflation rates are going to be over the length of such a long duration, bond in terms of the time length. So in this case, the coupon payment or compensation to the holder may be indexed to inflation. So for example, in the time regime when the inflation, spikes up more than a certain band, then the holder is compensated. An example are TIPS, which are Treasury Index Protected, securities, which are the U.S. Treasury issued securities, and in this case, or in this instance, the holders are compensated for a spike in inflation, or inflation if it happens more than a certain band. That additional sort of a rate compensation is then added to the compensation to the holder. So what is the opportunity cost of debt capital? Because the holder of the bond is going to be foregoing their current consumption of funds and be investing in a bond issued by the issuer. So they need to be compensated. They need to be awarded for the opportunity cost. So the discount rate is the opportunity cost of the capital, and in the rate that could be earned on alternate investment of equal risk. So what that means is I have many choices of investing. Now my funds, if I choose to invest in bond, then I'm foregoing, or I'm losing out on investing on some other security. Could be stocks, could be real estate, could be gold, could be anything else. So that is my opportunity cost, and I need to be compensated for my loss of investing in other assets and primarily selecting the bonds. So that is represented by the discount rate, or the denominator that we discussed, the required rate. So how do I assess that? That is a combination of several components. You can think of as a foundation of a wall, and then you keep adding floors to it. So you start out by the real rate of interest, which is the market rate or the nominal rate of interest. Primarily, the real rate and the inflation premium combined equate to the rate that we receive on risk-free securities, that is the Treasury issued security. So you got the real rate, you got inflation premium, you got the market risk premium, that is what the overall risk would come perspective to the overall market. If there's more risk in the market, if for example it's a recessionary time, overall the investors might ask a little bit of premium for the overall risk in the market. Default risk premium is primarily linked to the issuer of the bond. I mean, if it's a safe company, this default risk premium is obviously going to be lower. If it's a company which may have some financial problems, could be in risky situation in terms of product liability happening, or government enacting laws against generally that sector, that might hinder those future cash flows which have to come to the investor, and thereby this default risk premium is going to go up. Now, you can think of the default risk premium pretty much as a credit score of the company, like individuals who have maintained a good track record of paying back their obligations, financial obligations. They generally have a good credit score, and any loans they apply for, they get a favorable interest rate. Similarly, companies also have credit scores, and this is linked to the default risk premium. That is, how likely is a company to default on its financial obligations. And then you have liquidity premium. That is how liquid the asset is going to be if it were to be sold in the secondary market. Is it going to be easier to sell in the secondary market, or it's going to take some time? So, for example, if you had to discount a check, a check issued by a individual or company at a bank, it's fairly easy to discount it. You could take it to any financial institution like bank, or even to some of these supermarkets, and they'll discount the check. They might take some transaction fee, or in some instances not, and give you the cash. Now, if you were to sell your automobile, even if you own it, it doesn't happen as smoothly as case of a check. So in that instance, you'll call the check being more liquid than your automobile. It's as simple as that. So in certain instances where the companies are well known, where the issuing agencies are well known, usually the US Treasury have a ready market, a ready secondary market where the bonds can easily transact or sell, then it will be more liquid than a company which is not well known, maybe fairly new, and has issued a bond, and now the holder of the bond wants to sell in the secondary market. It may not be as simple as the case of Treasury bond. So then you would say that this company's bond is not as liquid as the US Treasury's bond. So let's now start looking at specific examples. So we have a case of what is the value of a 10-year 10% annual coupon bond if the required rate is 10%. Now obviously we can work it through the timeline, taking these periodic payments of $100 every year, because remember, this is a 10% annual coupon bond, and we're assuming that this is going to be $1,000 face value. So we would then add all these over a timeline, and at the very last payment you would also include the face value, because now the bond is maturing. So in the last payment you would have the issuer of the bond return the face value to the bond holder and the last payment in this case. And obviously these are discounted by the required rate, which is 10%. So we can also use our financial calculator or Excel, as we've been using, to calculate something like this. So again, let's just plug in the values. So again, recalling, we got 5 variables, and you have to know 4 to calculate the 5th. So in this instance, we know that this is a 10-year bond, and the required, you've given that there's a required rate of 10%. So in this case, we can just put 10% here. Present value, I do not know, because that's what I wish to calculate. I can leave it blank for now. Payment is 10%, so I can simply say 10% of 1000, and these questions will assume the face value to be 1000. So future value is going to be 1000. So again, recall that I put a positive sign for 1000 because that would be money coming back to me, because this is when the bond matures, the issuer of the bond is going to repay back to the bond holder. So all I have to do is find out the value of present value. So it will be present value, rate is 10%, number of time periods is 10, payment is $100, future value is 100, bracket close. So it's $1,000. So one thing that I want you to observe is that the present value is exactly equal to future value. Now, why is that? Again, remember that your payment is, the coupon payment is 10%, which is $100, and that is exactly equal to the required rate, or what the investors perceive as the risk to those future cash flows. So you are being compensated adequately for your risk or the opportunity cost. So as simple as that, what that means is you're being fairly compensated for the opportunity cost, and in this instance your present value is going to be, that's why, exactly simply equal to the future value or the face value of the bond. Now let's just look at some other example similar to this thought. So this is the case where the required rate I can simply put as RD here. This is 10%. Now what happens if the required rate is, let's say, 13%? That is, there may be overall risk in the market, or investors might feel the perceived risk to this particular bond issue. Now what happens in this instance? Let's see. So everything else remains the same. Only thing we are changing is the required rate. Now it's 13%. Future value still is 1000. Payment is again coupon payment of 10%. That's not changed. So this is going to be 10% of the future value, which is 100. So present value, rate is 13%, number of time periods 10, payment is 100, future value is 1000, bracket closed. Okay, so now we have present value dropping to 837.21. Why did that happen? Now think about it, because this is an instance where the bond is having more risk inherently because of any number of factors. The required rate has jumped to 13%, but unfortunately, since it's a bond and the contractual obligations do not change, the company cannot start simply issuing more coupon payment to compensate the investor for suddenly that rising required rate. So we can't change the face value, we can't drop it or increase it, we can't change the coupon payment, we can't change the term. Only thing that is then changeable is the present value. Present value to compensate the investor for the rising required rate, for that increased opportunity cost. The market self functions by dropping the price, the present value of the bond, and this is sort of a compensation for opportunity cost for investor. That is, okay, it was selling for 1000 when the required rate was equal to the coupon payment. Now that the required rate is more than the coupon payment, you're being compensated by this dropped or lower valuation of the present value, the bond. Now this is the fair value. It doesn't mean that the bond is going to sell at this price. That is between the buyer and the seller. Now what I'm saying is this is the suggested, this is the fair value of the bond at which it should be selling in the market. So I hope this is clear, because in certain instances, let me give you an example. Let's say when we purchase properties, home properties, sometimes emotions play in. I mean, we know that a certain property may be worth $200,000, but certain emotions might play in, and you might just be fixated on the property, and you may be willing to pay $225,000 for a property which is valued at $200,000. So this, again, just to make a point, this is the fair value, $837.21, but in actual instance, the trade might happen lower or more than this price based on the agreed upon transaction cost and other costs between the buyer and the seller. So let's take another example. In this instance, we'll have the required rate to be 7%. Again, nothing else changes. The coupon payment is going to be 10% of the face value, and I'll put 7% here. So calculating, I mean, any guesses in this instance where the required rate is now less than the coupon payment? Because now if the risk to the bond is now suddenly lower than what it should be for that coupon payment that's being paid, and remember everything else remains unchangeable, in this instance now the bond will be selling at a premium. It should be more than 1,000. So let's figure out what that price will be. So present value, rate will be 7%, number of time periods going to be 10, payment, and then future value. There you go. So now we have an instance where the bond is selling at a premium at 1210.71. So this is the case of bond selling at par. This is the case of bond selling at a discount, and this is the case of bond selling at a premium. There you go. All right, I hope that this is clear to you. So simply what we just did, this is the value of 10-year bond outstanding with the same risk but 13% annual coupon rate. In this instance, the coupon rate has been increased. I mean, I demonstrated varying required rate. What happens if the coupon payment is increased? So we can do that as well. So let's so I can plug in the values. I mean, I could have done it in one go, but just to make it clear, so I have 10 years, I have required rate is 10%, and then payment is going to be 13% now, which makes it $130 as coupon payment. Future value is 1,000. So present value is going to be so you can see that the bond is going to be selling at $1,184.34. Why? Because you're being overcompensated compared to the overall risk to the bond or for your opportunity cost. So for that, the market is going to price the bond as a premium bond. And here you have an example of a similar characteristics of the bond, but now you have 7% annual coupon, which is pretty much the same example as we did prior to it. But in this instance, like I said, the thing that's changing is the coupon payment. So we can quickly do that. And just to emphasize, I could do it in one go. That is, I can say present value, rate is 10%, number of time periods is 10, payment is going to be 70, which is 7% of 1000. I could do the same thing in the formula as well. So I can say 7% of 1000 and future value is 1000. So there you go. It should be $815.66. I mean, this is just to emphasize that you don't really have to write in the way that we had been doing. It was done to get you in a mode to start practicing how to calculate time value of money sort of questions in Excel. But if you are comfortable by now, you can simply start doing the way I just did in one cell itself. So then you can see this graphical representation of what happens or changes in the bond value over time. So what happens to the value of these three bonds if the required rate of the return remained at 10%? And that's what we had done in the first instance. This is the one, and you can see that starting out you have the values here, 1184, 816, and then as you move forward time frame wise, the present values, they sort of start converging, and right at the maturity date, irrespective of what the required rates were, they all converge to 1000, because on the day of the maturity there is no risk left anymore, because now today is a day, everything has went fine, and the company is going to pay you back the face value. So at maturity, the value of any bond must equal to its par value, because now is the day when the bond matures. So if the required rate remains constant, the value of premium bond would decrease over time until it reaches 1000. So there is going to be no premium on the maturity date. The value of discount bond would increase over time until it reaches 1000. Again, think of this as in a logical or intuitive manner, that as you are reaching over time closer to maturity, I mean, why are you charging premium, or why you are ready to give a discount on the value of the bond is because of inherent risk. Now, as you come closer to maturity, that risk declines. So the premium would also decline, and the discount which has happened over a period of time would now also sort of narrow it down, because as you come in closer, the risk is sort of is now lowering, and thereby any of those three conditions, I mean, par is going to be par, but the discount or premium are going to converge to that one point on the maturity date. So let's look at YTM, the concept of YTM. Remember, YTM is a concept of the return rate of return, return that investor would receive, is the rate of return that the investor receives given the bond is purchased at a particular purchase price, and it's held until the maturity, and we're assuming that all coupon payments are going to be paid as agreed upon on the contract or the bond, and we want to find out what is going to be the effective rate of return to an investor. So if you look at 10-year 9% annual coupon, $1,000 par value selling for $887. So we have N, we have this YTM, we have present value, we got payment, and then we got future value. So N is given to be 10. It's a 9% coupon payment, so 9% of 1,000. I'll assume the face value to be 1,000. It's given 1,000. Okay, so it should be 9%, not 9. There you go. That's $90. Face value is 1,000. Present value is negative 887. Remember, money going out is going to be negative. You know, if you're buying it, it's money going out. So I have to calculate the YTM, which is the effective rate of return the investor would be receiving if the investor were to purchase today. That bond at 887 is going to be getting $90 coupon payment for 10 years, and the future value of the bond is 1,000. So what should be the fair or the assessed rate of return given all these parameters? So this is going to be equal to rate, number of time periods is 10, payment is 90, present value is that negative 887, future value is 1,000, and so effectively the holder, given all this information, is going to be receiving right around 11%. So I can increase the number of decimal points just to make sure. So it's about 10.91%. So you can increase the number of decimals to get a precise answer. So this is going to be the YTM. So this is just to show that we have the right answer. So solving for IYR, which is the YTM in this instance, the yield to maturity of the bond is 10.91%. The bond sells at a discount because YTM is greater than the coupon rate, as we had assessed just in the previous slide. So you can see that the risk, remember this is selling at a discount. This is less than 1,000 present value. So the holder of the bond needs to be compensated for this change, because you're getting 9% in the coupon payment. So the bond holder has to be compensated. So find YTM if the bond price is 1134.20. I mean, I can simply just change it to negative 1134.20. There you go. So now the YTM is 7.08%. I mean, that's the beauty of Excel. You can simply work out different scenarios and find out what's going on. Now let's, again, this is going to be the case of the bond selling at a premium because YTM is less than the coupon payment. Let's look at the par, so it'll be 1,000 here, and change the payment to 10%. So it should be okay. That was a mistake because it should have been negative. That's why we had the error. Now it should come fine. Payment should be 10% of 1,000. That is a lesson for us. I mean, if we obviously input garbage, as we say, the end result is going to be garbage in, garbage out for computers. So YTM is going to be rate, number of time periods is 10, payment is 100, present value is negative 1,000, future value is 1,000. There you go, 10%. So basically here it's at par. You're getting compensated right at what you should be receiving as on opportunity cost. So your YTM is 10%, which is exactly as what we assume to be the coupon payment. So definitions, as we move on, we can calculate the current yield, which is annual coupon payment divided by the current price, capital gains yield, which is change in price divided by the beginning price, and the expected total return, which is YTM, which is equal to expected current yield plus the expected capital gains yield. So some examples around these definitions. Find the current yield and the capital gains yield for a 10-year 9% annual coupon bond that sells for $887 and has a face value of $1,000. So current yield is going to be the coupon payment, which is 9% of $1,000, that's 90, and the current price is $887. So 90 divided by 887 is going to be 10.15% approximately. So you can use that. I'll increase the number of decimal points. There you go. So 10.15%. So what is the YTM? That's going to be the current yield plus capital gains yield. But we can also reorganize the formula. So to get the capital gains yield, we can simply have the YTM minus the current yield. And remember, we just calculated the current yield, and we can then calculate the capital gains yield by taking YTM minus current yield, which is going to be 10.91% minus 10.15%. That's going to be 0.76%. So could also find the expected price 1 year from now and divide the change in price by the beginning price, which gives the same answer as we had done prior, to get the capital, gains, which is the change in price based on today's price minus the price we paid to buy that security at some point whenever we bought first. So what is price risk? Does 1 year or 10-year bond have same price risk? Remember, the price risk is a concern that rising required rate will cause the value of the bond to fall. So you can see that the longer maturity bonds tend to have more impact on the pricing of the bond if there were to be some changes in the required rate, because in short duration it's easier to forecast what the likely result is going to be if there's any change in the required rate. But longer duration bond, in terms of maturity, it is not easily predictable. That's why the market overreacts in case it's a longer duration or in terms of maturity bond. So you can see that in 10-year, the impacts are ranging, such as 38.6%, negative 25.1%, whereas in 1 year it's much lower. So 10-year bond is more sensitive to interest rate changes and hence has more price risk. So just to show you graphically, 10-year bond has a deeper incline than the 1-year bond in terms of the change in value. So what is reinvestment risk? Well, the reinvestment risk is the concern that the required rate will fall and future cash flows will have to be reinvested at lower rates, hence reducing income. So example, suppose you won a $500,000 lottery. You intended to invest the money and live off the interest. So you may invest in either a 10-year bond or a series of 10 1-year bonds. Both 10-year and 1-year bond currently yield 10%. So you could have a fixed rate for 10 years, or you could be thinking, well, I'll keep reinvesting after every year. So if you were to choose 1-year bond strategy, after 1 year you receive $50,000 in income and have $500,000 500,000, which is the face value, returned to you to reinvest. But if 1 year rates fall to 3%, so from 10 to 3%, the annual income will fall to 15,000. That's quite a drop. However, if you chose 10-year bond strategy, you have locked in a 10-year interest and $50,000 annual income for 10 years. So it's a safer strategy to be locked into this fixed rate for a longer duration. But normally you'll find that long-term fixed rates are not going to be the same as short-term interest rates. They are going to be different. But this is just an example to highlight the point. So conclusion about price risk and reinvestment risk. Short-term and high coupon bonds, the price risk is low, but the reinvestment risk is high. In case of long-term, the price risk is high, but reinvestment risk is low. So nothing is riskless. So let's take the case where you have bonds which may have the periodic payments, the coupon payments being made now not once a year, but let's say more than once a year. Could be quarterly, could be monthly, could be semi-annually. So here we'll have to work out some treatment. That is, in case it's a semi-annual bond, you multiply years, that means n by 2 to make the number of periods 2n, divide the nominal rate by 2 because it's an annual rate. You divide by the number of times interest is going to be paid to get the the periodic rate, and then divide annual coupon by 2 so that your annual coupon is divided by 2 in this case because it's a semi-annual bond. So let's take an example. So the example in this instance is, what is the value of 10-year 10% semi-annual coupon bond if the required rate is 13%? So similarly, we can do this. So I can just put IY for now, just so that your financial calculator also is looking the same as what we have here. So now this is a 10-year bond, but the payments are being made semi-annually. So this is going to be 10 multiplied with 2, the 2n. IY is going to be your 13%, but making it periodic, it's going to be 13 divided by 2, or 13% divided by 2. Just put percentage back here. There you go, 6.5. Present value I have to calculate, I can leave it blank. Payment is going to be the 10% coupon payment, so 10% of 1,000, and this divided by 2 because this is a semi-annual coupon, so that's $50. Future value is going to be 1,000. That doesn't change. So present value is going to be present value, rate, number of time periods, payment, future value. So it's going to be $834.72. So that's how you get the present value. So again, in these type of questions, the more you practice, the more familiar you will get. So again, like I emphasized in time value of money questions, 80% of the task is identifying the correct variables. It's only 20% which is actual calculation, because you already have a set rule how to calculate, so nothing is going to highly make a difference. Main task is going to be identifying the variables and treating those variables correctly. So just to give you a similar example, if this is for semi-annual, what if, so these are 2 payments, what if we make it quarterly? That is 4 times a year. So here n is going to be 10 multiplied by 4. In this instance, now it's going to be 13% divided by 4. And you can put the percentage again, so it'll be 3.25. Payment is going to be, we had 10%, so this is going to be now divided by 4. So 10% multiplied by 1000, and this divided by 4, which is, I'm sorry, should have been 4 here because I was thinking 25 the payment. There you go. So payment is 25, future value is 1000. So present value is going to be the rate, number of time periods, payment, future value. There you go, 833.44. So that is the present value. And this is how you'll calculate different types. You can do monthly, you can do daily. Now I think you must have got the idea. So would you prefer to buy a 10-year 10% annual coupon bond or 10-year 10% semi-annual coupon bond, all else equal? So obviously you know that the number of times the opportunity to compound a year helps, and that's preferred for investor, everything else remaining equal or same. So similarly, for semi-annual bond, the effective rate is 10.25%, which is greater than 10%. So you would prefer to buy a semi-annual bond. Like in this instance, would you rather buy a semi-annual or a quarterly paying bond? Obviously, everything else remaining same, you have an opportunity for having a higher YTM because you're getting to buy it at a lower price. So you definitely would like to buy a quarterly bond in this instance. And in the example on the PowerPoint, this is going to be the fact that you would prefer the semi-annual bond. So if the proper price of semi-annual bond is 1000, what would be the proper price for annual coupon bond? So semi-annual bond has 10.25 effective rate. So the annual bond should earn the same EAR, effective annual rate. At these prices, the annual and the semi-annual bond are in equilibrium. So we can calculate that, which is going to be again N by Y, present value, payment, future value. So this is given to us 10.25. Payment is going to be 10% of 1000, which is 100, and future value is 1000. So present value is going to be rate, number of time periods, payment, and future value, which is 984.80. So I think now you pretty much are getting used to it. So a 10-year 10% semi-annual coupon bond selling for 1135.90 can be called in 4 years for 1050. What is the YTC, yield to call, not yield to maturity, because now we are having a shorter cycle, for the bond. So it's not YTM but YTC because we are looking at the 4 years. So again, N YT, I can put YTM, YTC, not YTM. Yield to call, present value, payment and future value. How do we calculate that? Now remember, the bond is going to be called back in 4 years, but it's a semi-annual bond, so you'll be 4 multiplied with 2, so 2n, and here is 4. YTC I do not know, so I'll leave it blank for now. Present value, we know that saying the bond is selling for 1135.90, so I'll put the present value to be negative 1135.90. Payment is, it's a 10% semi-annual coupon bond, so 10% multiplied with 1000 but divided by 2 since it's a semi-annual, and the future value will not be 1000 but 1000 plus the $50 penalty that the company is going to pay, or the issuer of the bond will pay to the holder to call the bond early, which is going to be in this instance 1050. There you go. So YTC will be rate, number of time periods is 8, payment, present value, future value. So let me just make sure. Oh, the payment should have been not multiple, so this is the error. This should be divided by 2. There you go again. Now we get the right answer. So again, we have to be just careful in plugging in the values, because the computer just spits out the results based on what we plug in. Again, opportunity for everyone here. So 3.57, that is the YTC, but remember this is a 6-month rate, so to make it equivalent 1 year, you multiply that by 2. So there you go. This should be your effective YTC, 7.14%, which is an annual rate. So this is what they've done here. So 3.568 represents the periodic semi-annual yield to call. YTC nominal is equal to R nominal. So we do the same thing. It's going to be 7.137% is the rate that a broker would quote. The effective yield to call can be calculated by using the formula, which is effect. So this is the rate bond broker would quote, so you can use effect and nominal rate, and then 2. There you go. So this is going to be your yield to call, 7.26. All right. So again, just have to follow the steps, and there is nothing very complicated here. So if you bought these callable bonds, would you be more likely to earn YTM or YTC? Now remember, the coupon rate is 10% comparable to YTC, which is equal to 7.137 that we just did here. This is the first step. There you go. The firm would raise money by selling new bonds which pay 7.137 because they are sort of refinancing. They could replace bonds paying $100 per year with bonds paying only 71.37 per year. Investors should expect a call and to earn YTC of 7.137 rather than the YTM of 8%. So when is a call more likely to occur? In general, if the bond sells at a premium, then coupon is greater than the required rate, so a call is more likely. So expect to earn YTC on premium bonds and YTM on par and discount bonds. That is the general takeaway from our discussion. Default risk, as I had mentioned, if an issuer defaults, investors receive less than the promised return. So sort of a credit, number or credit profile of the firm will sort of influence the default risk premium that investors might charge. Therefore, the expected return on corporate and municipal bond is less than that of the promised return, influenced by issuer's financial strength and the terms of the bond contract. Types of bonds: we can have mortgage bonds, which are tied to mortgages, debentures, subordinated debentures. So again, there's a seniority as to how the settlement will take place in case the company were to be liquidated. So higher in the chain, more senior that asset or security is, lower in the chain, more subordinated that asset or bond or other security might be. You could have investment grade bonds, which are highly or so-called highly secure in terms of the grade that's assigned to them, in terms of the score. They're supposed to be, or in all fairness, they are safer investments. And then you have junk bonds, which are highly risky. Companies may not be financially strong. Investment on these bonds is cautioned, but investors are still there because they can make some good money, because the YTM on these bonds are pretty high given the risk to the bond and the future cash flows. Just to give you an example of how the bonds might be rated, sort of a letter grade as we have in class for GPA and so forth. Moody's, they give you AAA, AA, Baa. These are investment grade, so investors can be fairly certain about the return on the investment. Similarly, S&P also have the grading system, and then the junk bonds, which are highly speculative, highly risky bonds. So bond ratings are designed to reflect the probability of a bond issue going into default. What are the factors affecting default risk and bond rating? You have financial performance, the debt ratio times interest earned, how well the company is placed to pay interest obligations, current ratio, and then you have qualitative factors, bond contract terms such as secured versus unsecured debt. Secured, you have something which is backing the debt. Could be a physical asset, could be a collateral, could be some money or cash set aside or being set aside to back a certain bond. Unsecured is primarily just on the goodwill and the faith or the name of the firm or entity issuing the bond. Obviously, investors are going to charge a premium for unsecured debt because it is going to be a little bit more risky than secured. You have senior versus subordinated debt. Like I mentioned, senior means if a company were to go into default, is liquidated, the senior debt is going to be settled first and then subordinated comes later on. So there's highly more risk to subordinated debt because investors may not be able to get all or some portion of the investment, so they're going to charge a little bit more premium for that kind of a bond. Guarantee and sinking fund provisions, again, debt maturity, all those factors also impact bond rating. Miscellaneous qualitative factors, analysts will look at earnings stability of the firm when rating these bonds. They'll also look at regulatory environment. For example, the products that the company is engaged in, do they have a smooth market or there are a lot of legal complications? So for example, let's say a company deals in tobacco or liquor, and suddenly there are new legislation that comes out which severely impacts the sale of tobacco and liquor. So obviously bonds of that company are going to be not graded very high because future cash flows are going to be a little bit under question. Potential antitrust or product liability. We had a similar example of airbag malfunction in some of the Honda and those cars, Takata airbag instance, where the company came into severe problem because of recall, a lot of cash problems. That is a case of product liability. Pension liability, another example, and labor problems. So as I mentioned, bankruptcy, there are two main chapters of Federal Bankruptcy Act. You have Chapter 11, which is reorganization, and Chapter 7. So for large organizations, reorganization occurs more frequently than liquidation because the cost of the company being liquidated is much more to society and stakeholders than if it were to be liquidated. So the company is given an opportunity to reorganize. So particularly in these instances, the business is worth more alive than dead because of number of jobs that are associated if they'll be lost if the company is liquidated. A lot of businesses are simply tied to a large company. For example, the case of GM in recent financial crisis when they were bailed out. The reason being there were tens of thousands of direct jobs related to the company. Then many small businesses were suppliers 100% to this large entity. So if GM were to be liquidated, the jobs would have gone. These entities directly related in terms of suppliers to GM would have been severely impacted or shut down. That would have meant additional job losses and financial losses. Then wherever these firms set up, their headquarters or their operations, plants and so forth, other small businesses, come up like restaurants and shops, entertainment and other, because people are living there who are working at these firms and they are spending in the social circle. So other small businesses come up, towns come up and so forth. So it's an impact not just to the company but to the stakeholders around as well. And then the dealer network would have been impacted, obviously, and the jobs at dealers, and then those dealers impacting their local society and so forth. So if company can't meet its obligation, it files under Chapter 11 to stop creditors from foreclosing, taking assets and closing the business, and it has 120 days to file a reorganization plan. The court appoints a trustee to supervise the reorganization. Management usually stays in control, so that's another incentive for the management team, because if it's liquidated, management team is going to lose their jobs. So they are interested in reorganization because they get to still be in control of the firm and they have a chance to revive the firm. So company must demonstrate in reorganization plan that it's worth more alive than dead, and its closure could impact the society or stakeholders at large. If not, the judge will order liquidation under Chapter 7. So what is the priority of claims in liquidation? If the company is liquidated, first and foremost, after the company is liquidated and sold off, all assets are sold, the funds are first applied to secured creditors from sale of secured assets. They get the claim first. Then the trustees' cost appointed by the court. Wages subject to limits, taxes, unfunded pension liabilities, secured creditors, preferred stock, and finally common stock, because common stocks are a representation of the owner. So after everything is paid, then any money that's left is then distributed amongst the owners of the firm. In most instances that never happens because most of the money is used up in first 4 or 5 broad areas. Beyond that, 6, 7, 8, they may not even get anything. So that brings us to end of the discussion on this chapter.